So I was talking about Larsen Tubro is one of the company which is involved in setting up a lot of projects in India, road projects, solar power projects, and these companies are called EPC companies, engineering, uh, EPC, procurement and construction. So EPC stands for EPC. It's written there, engineering, procurement and construction. Okay. So this company is involved in a lot of big projects in India, and it is one of the biggest companies in India in this field. So that's why I'm sharing. There are about 117 companies in India who are of a similar kind of profile, okay, which are called EPC companies, right? And most of the job is done by these companies for whenever a new project, a large project is set up in India. Either any company will be involved in setting up the project for them. Okay. So Larsen Tubro is basically a company which has a market cap of 5,69,000 crores. Okay. So it is which cap? Is it large cap or mid cap or small cap? Large cap. So how many companies large cap? Anyone? What is the criteria of a large cap? Okay, there's somewhere right in it. Yeah, somewhere people can't remember. But I think large cap people are not knowing it, the criteria. And I think you would be knowing it, as she said, because she knows it. The top 100 companies in India, in terms of market cap, they're called large cap. This is a definition given by SEBI. And the next 150 companies in India, in terms of market cap, they're called mid caps. And rest of them are small caps. There are about more than 5,000 companies which are listed on the stock exchange. Okay. The top 100 is called the large cap. And this is the 12th biggest company in India in terms of market cap. The latest market cap is 5,69,000. Now, there is a side, the SEBI has, in 2017, I don't know which year it was, they defined this criteria, particularly for mutual fund industry, because they were coming a lot of schemes, say it's a large cap scheme, it's a mid cap scheme. So they said, okay, everyone should be on the same platform. So we are going to define about large cap, mid cap, and small cap. Okay. So every 6 months, the mutual fund association, okay, it's called by some different name. So they publish this data. Okay. Okay. So I'm just going to share that. Okay, this one. Look at this sheet. So this gives you, the top 100 companies. So large cap, mid cap, and small cap. Okay. So what I did, I just, went to the site and got a PDF file, and then the ChatGPT has done the rest. It has segregated all the caps. So this is Reliance is showing 17. Now look at the 12th number, Larsen Tubro. It is 4,72,000 crores because it was published 6 months back, 30th of June 2025, when the number was published. So every 6 months, this association publishes all the data with regard to all the companies and gives them in terms of whether what companies, large cap, small cap, mid cap thing. Okay, I'll just share you this file also. So Larsen Tubro is the company which is the 12th largest. The top company is Reliance with 17,78,000 crores. But if you now look at it, is more than 21 lakhs. So Reliance is having today a market cap of 21,38,000. So this is the biggest company in India. Okay, and which is the biggest company in the world in terms of market cap? Any idea? Nvidia. Yeah. Okay. Previously it was Apple, but now Nvidia has taken over. Okay. So let's go back and see the Larsen Tubro. And if you look at, again, this sheet, what I have done, I have just added, how much return this company has given. This information. Reliance has, gone up by 27% in last 1 year. Whatever price it was about a year back. So the people who have invested in Reliance, they have got 27% return in last 1 year. It has done very well. It has even, surpassed Dow Jones, Nasdaq, any other indicator, any other, index. So it has been one of the best performing company in the world. Of course, like Nvidia and other companies might have done much better, but Reliance has done also equally good. And if you look at, a company like Larsen Tubro, it has grown by 14%. So it has given 14% return to its shareholders, which is a good amount. Okay.
Any company which gives around 14 to 15% is considered to be in a good bracket. India, Nifty has given around 10% return in the last 1 year. Okay, this was a muted return, but Nifty has given 10%, and Larsen Tubro 14, and Reliance around 27%. Okay, so let's go back to the Larsen Tubro and understand something more. So this is the company, okay, which is basically involved into all these jobs. Just anybody can read this. Basically, about. Or just read it in your mind, all of you, so that I understand what this company is doing. So it's a conglomerate.
Saying to you, limited in the multinational conglomerate, which is primarily engaged in providing engineering, procurement, and construction solutions in key sectors such as infrastructure, hydrocarbon, power, process industries, and defense. Information technology, financial services in domestic and international markets.
Okay, fine. It's okay. So that means it is, setting up power plants. It is setting up, industries. It's also present in setting up infrastructure for India. Okay. So this is a company which is called an EPC company, engineering, procurement, and construction. Okay. And now, if you want to see what are the other companies, then you go to the peers. Okay, and look for, and there are about 116 companies. If you look at the bottom, there are 116. Only 7 are being displayed here. Okay, and Larsen Tubro is right at the top with market cap of 5,69,000. And the next best is Rail Vikas, NBCC, IRB Infra, Kalpatru, KEC International. So these are the other companies which are similar, but they are nowhere near the size of Larsen Tubro. Larsen Tubro is the biggest company in India. Okay. So let's go back. So now, if you look at some of the things, once you open the account and have your ID and password, you can just add a lot of things to the table. Okay, like if you people are familiar with that, so you just go at the bottom and you can add all the information which has. So you add the ratios, whatever ratios you want to add. Okay, which are not visible by default. There will be about 10 ones. Then you can keep adding those if you want. Okay, I'll just share you the screenshot of this on a WhatsApp, so you can add those this thing also. So now let's see some information about Larsen Tubro. So let's look at its profit loss account. Okay. So what is the top line? The turnover of the company is close to about 2,70,723 crores. So company is doing a turnover of a top line of 2,70,000 crores. That's a TTM number. And what does TTM stands for? Trailing, you don't know. Trailing 12 months number. Every company in India is supposed to announce its results after every quarter. Okay. Now we have 2 quarters have been already declared. April, May, June, July, August, September. October, November, December quarter is over, but the results will get declared by the end February. Okay. So 2 quarter numbers have been already declared. So if you take these 2 quarter numbers and add the previous 2 quarter numbers and add them up, they'll become trailing 12 months. That means in the last 12 months, how much business the company has done. Okay. And how we can arrive is by looking at the quarters here. So if you look at the quarters, so this is giving you quarter wise. So company is announcing quarter wise results. And if you add the last 4 quarters like this, you will get the same number, TTM yearly number. Similarly, all line by line items, TTM numbers are given. Okay, fine. So if you go back to again the profit loss account, so the companies now, if you like, why this number is so important, the TTM, because the last number was March, which was declared audited accounts. But now 2 quarters have already gone, and you want to know how the company is doing. Now look at the top line. Is it growing? It's showing the TTM number saying that it is going from 2,55,000 crores to 2,70,000 crores. Okay, so company is doing well. And in another 10-15 days or a month, we will have the 3rd quarter also number being included in that. So the operating profit has also gone up or almost remained the same, 34,000 to 34,000, isn't it? But let's look at the net profit. It was 17,000 crores and now it is 19,000 crores. Look at the bottom. The last number is earning per share, which is very important, which has already gone up to 190. So company is generating an EPS. It's going from 35 to 34, then 40, 52, then 61, 74, 95, 190. So the company is making profits for the shareholder. It is now making 116 rupees, 119 rupees per share. Is that okay? Fine. So let's come back to this. So now after the market cap, the current price is given, which is 4,141 rupees is the current price. Okay, fine. And the high and low is also given to you. It has touched 4,195. Okay, at the highest in the last 52 weeks, and it was 2,965, the lowest in the last 52 weeks. So it's done well comparatively. It's now almost trading at its peak. Okay. Now there's one more thing which you must see is the chart. Okay. Now, if you see the company's share price in the last few quarters or last few months have gone up, isn't it? So it's showing a trajectory where the shares of the companies are also rising, isn't it? And if you look at the last, 10-year or maximum chart, so you'll find there's a long-term trend also of the share is very good. The company has been phenomenally performing. It's rewarding their shareholders, doing more and more projects in India, and the share price is on a bull run. Okay, secular bull run, which we say. And of course, it's not linear; it keeps going up and down. But over the time, the share price has been growing. So let's go back to 1 year. So this is, you find the share price has been going. But, somewhere in April last year, the share price has gone down. Okay. It touched, 3,000, most of the, Indian shares, they came down in this period. So it's reflecting almost like, the pattern of Nifty because it is a proxy to India's economy. Okay. It's a company which is doing so many projects. It mirrors the broader index performance also. Not all the companies, but this company can always mirror the broader performance of the Indian financial markets. Okay. Now, if you want to know, so you should have, another line drawn here, which is called 50-day moving average. So if you plot a line which is called a 50-day moving average, which is the 50 days price of the stock divided by 50 and keep making a graph of it. It filters out the noise. It makes the graph smoother, but it slows down compared to the price. It is a slow moving, a lag indicator. Okay. And if a 50-day moving price, if the price is above the 50-day moving we say the stock is doing well. It is in a bull trend. It is a stock worth buying if it is over and above the 50-day moving average. Okay. Then we can have even a 200-day moving average. So it's called pair of moving average, which completes the story. That you look at, there are three things to now look at: the price and two pair of moving averages. Now it gives you the long-term direction of the stock. All the long-term investors, they look at the two moving averages and the share price. If the share price is above both these averages, that means the long-term trend is up. So if you see, the share price is above both the moving averages, 50 and 200. And 50 and 200-day moving averages. 200-day moving average provides a strong support to the share. Okay. Once it crosses the 200-day, it is very difficult to pierce below the 200-day. So it acts as a resistance. It acts as a support. Okay. But once the support gets broken, then the same line will become a resistance line. So whenever it goes down, it is very difficult to go up from that moving average. Where it's at 200-day off. Another very important thing is that you can see the two lines are crossing somewhere. Okay. The 50-day has crossed the 200-day moving. Okay. It is called a golden crossover. If that happens, the market is signaling the stock is a long-term uptrend. The pattern has changed from a bearish to a bullish pattern. But if it happens the other way around, it's called dead cross. Okay. Right. Here we have a golden cross. Okay. Now, if you look at the cross here, you find that the share price has been moving from there on. Okay. it's been going up. Most of the time, it has fallen, but then it has touched the 50-day or 200-day average and then gone up again. So the bull trend was uptrend, was intact, and it has just been tested at times. Okay. Now, another thing, very important thing we should note before we go to the thing, that the crossover has happened, but the trend began much before because these are lag indicators. Okay. The share price of Larsen Tubro had started going up, but the trend was confirmed only after 2 or 3 weeks because these indicators or moving averages are lag indicators. They don't tell you, but they tell you and confirm to you that after some time, after a 15 days or 10 days period, they'll confirm, yes, really, it's a time the share price or the market or anything will do well. Okay. So it's called the golden crossover and it's a lag indicator. So people wanted to know that, we should know much earlier why we are doing it after 3 weeks. Okay. So there is another indicator which is the advanced version of moving average. It's called MACD, moving average convergence average, which tells you almost exactly the time when the share price starts moving. We can't predict because it is also a lag indicator, but it tells you that it almost at the same time when it confirms the pattern of the stock at a much earlier. You can just Google and find this thing and learn it for yourself if you want. So this is about the moving averages, and these are all called technical analysis. Okay. Now there are two things which are very important. One is the fundamental analysis, technical analysis. So this is the technical analysis, a little bit of flavor. So let's go back to the chart again. Let's go to this figure. Is that okay? Is it clear? Now, the share is currently trading at a P multiple of 35.6. Okay. So company is trading at a P multiple of how much? 35.6. Okay. Now, this ratio is a valuation ratio. Okay. It's a valuation metric. It's a relative valuation. Okay. So it's trading at 35 point whatever. How it is calculated? Market price per share divided by the price by the EPS. Okay, fine. So there are 3 versions to the P ratio, and this is the P ratio which we normally look at. This is called trailing P ratio. This is called trailing P ratio. It is the market price per share divided by the last 12 months trailing earning per share. It is not the last year March EPS, but it is the right up to the company has announced the result. We have taken that EPS to find out the P ratio. So it's trading at how much? 35.6. Okay. Now, from this number, you can know whether this share is overpriced or underpriced, or it's a rightly priced. Okay. So is it overpriced or is it underpriced? How do you know that? By taking the peers of the company.
Your industry.
Okay. Now, look at the industry P ratio. This is the industry P ratio. Okay. Industry is trading at a certain P ratio. How much it is? 18.8. So there are 117 companies. They are having an average P ratio of, or the median P ratio of 18.8, whereas Larsen Tubro is trading at how much? 35.6. So now, is it overpriced, underpriced? Overpriced. So when the share price is going up, if it is overpriced, the share price would have not gone up by so much. So that means somewhere there's something missing. Okay. Some link is missing. We should understand something more about it. Okay. Now that which you said growth. Somebody said growth. Yeah.
Future growth expectation.
Yeah. Okay. So I'm coming to that only. That's a good point. What's your name?
Ashutosh.
Good. So now there is, another ratio which you must look at before finding. Now, first of all, we must know that why the share price goes up. There are 2 things, okay? Why the share at a higher P multiple or why the share price goes. The share price goes up because of 2 things. One is, what is the growth prospect of it? How the company is growing. If the company is making big profits, it will command a higher P. Okay. Second is, what is the profile of the company? Is it risky company? Now, or non-risky? Now, Larsen Tubro is a conglomerate. It is present into so many businesses. Okay. When you're present in so many businesses, you take out the risk from the business. Okay. Because some businesses will do well, some not. Ultimately, the company will keep progressing. Okay. But all the time, it will showing a good result to the stakeholders or a shareholder. So it's less risky. Okay. Compared to the other companies. And it is always measured to beta or standard deviation kind of a thing.
So, according to me, it's not that risky. So, it will command a higher PE compared to the other company. Okay. Now, the second is what is the growth prospect of the company? How the earnings per share is going to grow in future? Of course, something which had happened in the past. We always look at the future because if I have to invest, then I must know what the company is going to do in the next few years, how it is going to grow. Okay. So then we look at the analyst estimates. How they are projecting this company to be, how much earning per share the company is going to do. We'll go into that. Before we go into that, we go to the, if you see that, we have seen the profit loss account of the company, okay? And you look at the EPS number, because the EPS number is very important. Look at the EPS number. The EPS was, right at the beginning it was 35, then it has been gone to 119. And last year, 109, then 95. So it is growing at around 15 to 16%. If you calculate, it will be going at 15 to 16% kind of a growth has been given in the bottom line. The bottom line is being growing by to the tune of 15 to 20%. Okay, fine. So let's go back to the main screen, Larsen Tubro. And then we look at the P ratio. What was the P ratio here? 35.6. Okay. So there is one more ratio which is called the PEG ratio, which is given there, which is nothing but the P ratio divided by growth. Growth in EPS. Okay. Now, the PEG ratio is given, which is how much? 1.5. 1.5 is equal to the P is how much? 35.6. So what is the growth is missing, isn't it? So we can calculate the growth. How much growth, what the analysts are predicting, we can be calculating. How is right matter calculated? How much growth you get? Roundabout, I think 23-24%. 23.9. Okay, so that means the analysts are saying this company is going to grow at almost like 23% earning per share per annum. This is the analyst estimate, average estimate. So there will be 30, 40 analysts whose average has been shown as a growth there. So let's see actually what the analysts are saying. So we go to a site called Trading View. Okay, and then we go to Larsen Tubro here and go to overview here. Okay, not the chart but overview. So we are on the Larsen Tubro's listing tab here and see the forecast. And of course, analyst is saying go and buy it. It's a good share. Okay, despite overvalued according to your estimates. But let's now look at the EPS growth. Okay, EPS is, let's make it annual. So currently it is 108. We saw TTM number was 119 or something. So 132 is expected this year, then 159 in the next year, then 188. So the earning per share is going to be going like this. According to how many analysts? There about, let's see how many analysts were there. There were 32 analysts, okay, who are actually giving the numbers, and these are the average numbers. Okay, fine. So if we see 108 to 132, so almost like 20-25% growth, it is telling. Okay, then see, if you see the average of all this, you can calculate the growth expected in future, which will be above double digits. Okay, like above 20%. So that is being factored into this thing. Now, if you see the last line, there is negative, 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 and a positive. So these are basically the reported number and estimate number. So analysts basically they estimate how much earning per share the company is going to deliver. But the companies announce results. So sometimes it beats the street expectations, sometimes there's a positive surprise, sometimes there's a negative surprise. Of course, there have been some negative surprises in the past, but in the last year it was a positive surprise. Okay, fine. This is just an explanation. So coming back to this, so the companies has a PEG ratio of 1.55. So it is like this. So PEG ratio
if it is 1, it can be, greater than 1, and less than 1. So there are 3 scenarios possible. Valuation. If it is greater than 1, the company is trading at premium to its growth. Like suppose if it is 35.6 and 24, it is when we get 1.55. So that means it is greater than 1, it is trading at premium to its growth. Here it's trading at premium to its growth. If it is less than 1, then we say it's trading at discount to its growth. If it is equal to 1, we say that it is trading at par with it. So the right company would be to select those companies which are the first two, which is below 1 and equal to 1. So these are companies that are going to grow much faster and better because they are not highly valued. Now, Larsen & Toubro is already 1.5. Okay, so it is trading at a very high PEG ratio. Okay, but it's a relative field. Okay, fine. If you look at Nifty is today trading at. Let's go to Nifty here. So this is the Nifty 50. Okay. Nifty is trading at 22.9 P ratio. Okay. This is the broad-based index Nifty. Okay. Which is itself trading at 22.9. Okay. And now the next year is expected by the analysts that the Nifty's companies will show a 15% growth in EPS. So what is Nifty's valuation? If suppose all the 50 companies on an average are going to grow, give a EPS growth of 15%. So what is the PEG ratio of Nifty itself? 1.4. So Nifty is already trading at 1.4. Okay, on the future expectations. If you look at any number in the world, they good come like USA, they all trade at 1.3, 1.4 times. Though theoretically we say that it's below 1, it is good. You should buy those companies, but you will never get those companies. So you always get above 1. But now you look which is the best out of all companies which are trading at a very high PEG ratio. So 1.4 itself, Nifty is already trading at. India commands a premium from the rest of the countries. Okay. So there is always a 30 to 40%, kind of a premium in Indian stocks market. So that has been captured by, Larsen & Toubro also as well. So now coming back to Larsen again. So this is Larsen & Toubro. Okay, now you go to chart again. Okay, and go to the the P ratio chart. So what is the median P ratio? 31.9. So historically, it has been trading at a P multiple of close to about 32, and now it is trading at 35, slightly above the historical average. So now we can make a complete picture that it is trading at a good P ratio, not very expensive, because historically it has been trading at 32 and now it is trading 35. It is costly, but not overvalued when you look at the industry P ratio, which is 80. So if you want to make a complete assessment of a company, whether there is overvalued, undervalued, so we saw all the things. The PEG ratio 1.5, okay, which is according to definition is expensive, but Nifty itself or other countries already trade at good, countries which have a good profitability, they trade at 1.4, 1.5. So it is trading at that threshold. Okay, expensive, but still, because we are in a country which is growing. Okay, which is growing, so we'll never be able to buy cheap. So you will have to buy something expensive. But out of the most expensive, you have to buy something which is less expensive. So it is expensive but less expensive. Then you look at the median P ratio, you find that it has been trading all the time at 32. So now it is trading 35. So it's costly. So if you want to invest in this company, wait for some correction to happen. Okay, it will give you a good result. So that is the whole idea of checking the valuation. So you people have done valuation course last quarter. So what is this valuation called? With this method is called relative valuation. Okay. So there is another method of valuation which is called DCF. Which is better, DCF or relative?
It is easier to understand, but actually the best method is DCF because it gives you the intrinsic value. Not this value is based on the market value. Markets can make mistakes. Markets can sometimes be expensive, sometimes cheap. So we are trying to, it's like there's a pricing mechanism. It's not finding the valuation. So the real method to calculate what should be the real price for the company is to find its intrinsic value. By projecting how much profit it's going to make, calculating the cash flows, and then discounting those cash flows and calculating the value of the company, you get the real or intrinsic value. But in relative valuation, it's very easy to do it. And you can still make the same investment decision as you can take DCF. DCF takes a lot of time. And again, DCF make a lot of assumptions. Okay. Suppose I'm doing a valuation of one company, another person is also doing. So we'll all come with some different results. Okay, depending upon who is giving you the inputs. Like suppose if I have the MBA of the company, I go to the CFO of the company or CMO of the company. So all will give me some different numbers. And I'll come with different kind of valuation for the company. Okay. That will involve a lot of calculation. So the right method is called the DCF method. But relative, if you understand, then you can always make your analysis and have the same. Suppose you want to buy a house, when you look at the market, if the market has gone up by 15%, 20%, still you buy the house. So you try to buy the cheapest house. The price have gone up. Somebody said they are already gone up by 25%, don't buy because they'll correct. You don't wait for that. Okay. Sometimes you have to accept the price which is prevailing in the market. Okay, so now we move on to the course, financing large projects. Okay, the slides have been already shared with you. Okay, I'll just share some more slides on the WhatsApp group whenever required. So, who was reading? हाँ, सक्षम. तो आपको ये पढ़ना है थोड़ा सा. So when I did ask you to say that, okay. So this is a definition. So we are going to understand what is a large scale project. A large scale project. Just read. Sorry.
Large scale project is a capital intensive long term investment typically involving high upfront capital expenditure, long construction and operating period, multiple stakeholders and complex contractual arrangements, predictable long-term cash flows. Okay, so there are a couple of things here. First, high upfront capital. So it requires a lot of capex, 1,000 crores, 2,000 crores, 3,000 crores. Whenever a project requires a lot of money, it's called a large-scale project. Then long construction period and operating period. So that means it may take a lot of time to come up. Okay, and then it is going to last for long. It is going to be operated for next 30, 40 years and will start producing results for next 34 years and producing revenue for the sponsors or for the company who has started this project. Then multiple stakeholders and complex contractual arrangements. So it's far more complex than, a small project because there are multiple stakeholders and we'll understand who are those and a complex contractual arrangements. So we're going to dwell on that little later. Just understand this is this thing. Predictable long-term cash flows. So the cash flows are predictable and long-term. The company is going to last or the project is going to be there for 40 years. And the cash flows are quite predictable. Okay, how come? We'll understand that. I'll explain that when I get at this thing. So let's just move and then I'll tell you why there is a predictable cash flows. Okay, and all those terms I'm going to explain. So power plants, thermal and renewable. So these are, large projects. So either they are thermal, that means coal-fired, plants. Okay, then we have the solar, the wind and the water based. So these are renewable power projects. So these are all long, big, projects which involve a lot of capital. Okay, fine.
Then we have the highways, the airports, the metros. So these also involve large capital outlay and longer time to operate and build. Okay. Then we have gas and oil fields. Okay. Fine, where the gas can be extracted, or it requires a lot of capex to drilling and everything, and taking out the oil consumes a lot of project, and it takes time before the oil starts coming after the oil field has been discovered. Then we have the mining and industrial parks. Okay, mining and industrial parks. Just read जो नीचे line लिखी है, just read, and then I'll go to the next slide. So these are the parks developed by the government or the state governments. It's like this. So we have the developed this code.
Internal roads, power distribution and substation, power supply and water treatment, pipelines in some parts, warehousing and logistics facilities, common utilities, ECP, STPs, fire systems, security and administration.
Okay, so there are parks which are developed by the government, which will have they will give factory lands, plots to the to set up plants for them. So they'll have internal roads already made by the state government. Power distribution and substations are there, so that it can take care of the needs of the power of the entire industry. Water supply and water treatment plant. So the water will be available. Okay, full supply of water is there. Water treatment plant is also there. Gas pipelines in some parks. Sometimes the gas pipelines are given to run the DG sets. Okay, or other equipments. Then the warehousing and logistic facilities. So they are provided by the government in a park, so that it gives complete, a park where companies can come and set up their businesses. Common utilities like ETP, okay, STP, fire hydrant system. EPT is basically the water treatment plants or the effluent waste treatment plant. Okay, so these are there. Suppose there are a lot of factories who are going to use the water and add some chemicals, and they're going to throw those chemicals, but before they are being sent to the sewage, they need to be treated. Okay, so that it doesn't pollute the environment. Okay, like I was just telling the last class, I was working in a company called SRF, a very big company and a very good company. I'll just share something more about that later. So that company, it was on 100 acres of land. On 50 acres land, the factory was built up. 50 was vacant. All green, maintained fully. Okay, so it's a big plant there, and in a place called Malanpur, which is near to Gwalior. So we used to use a lot of water for making steam and other things. So then we used to treat them and use a lot of chemicals also in the process, which is called the polymerization process and other processes. So we used to mix up a lot of chemicals and produce our final product. So we used to, at the end of the day, we used to treat the water, and then that water which was treated was used for horticulture purpose, for growing the garden and the park. No water was thrown out of the factory, and there was in the middle of that, there's a pond. Okay, a small pond was there, and a lot of fishes were there. So one day my engineer, who was looking after that area, so he took me to that place. He said, "This is the pond, and see the fish. They are all live. They are all inside." So I said, "What's the purpose of having a pond right in the middle of the factory?" He says, "The water is getting treated, and after the treatment, it's passing through the pond. And if the fishes are alive, that means we have treated the water. Absolutely okay. And then the water is used for our other needs. It can be used for drinking, for whatever purpose you can use. But the live fishes tell you that the water has been cleaned. If any fish dies, that means the process has been, somewhere the process is not working." So we used to have, an annual inspection from the pollution board. They used to come and, people used to take them to the pond to see that everything is moving. So you don't have to do any fart testing. If you look at the pond, if there are no fishes, they're all alive. Nobody's dying. So that means the water is properly being treated. So they used to see the fish pond and then go back to their headquarters and saying, "Sab cheez theek hai." Okay, so this is just the story. Okay, so these are the common, effluent treatment plants or STP plants. STP is what? Just Google STP? Huh? Which one? Sewerage treatment plant. That could be there. Well, yeah, water treatment or something like that. Okay, fine. And then we have the common security and administration of the solar park. Now, this is the characteristics of large projects. Okay, just read them.
High investments of often run into hundreds or thousands of crores, long gestation, construction 2 to 7 years, operation 20 to 40 years.
Okay, hold on. So first, high capex. It will involve a lot of money. Okay, fine. And then long gestation period. It will take construction to about 2 to 7 years to construct this plant. And then it will have a lot of operating life, 30 to 40 years or 20 to 40 years. Then now special purpose vehicle. This is very important. SPV. Now, whenever a new project has to be started like this, so SPV is formed. A new company is formed, which is called SPV, special purpose vehicle. Now, suppose I am a company already. I want to start this. I want to participate in a project. I will not do under my corporate umbrella. I will form a new company. I will float a company. It will call SPV, special purpose vehicle, which will carry the business of this project. The plant will be set under the new entity, which is called SPV. Okay, fine. Project executed via separate legal entity. Now, it is a separate company having its own assets, which are the project assets, everything. Okay, it's an SPV. Okay, read further.
Non-resource, limited resource.
No, not resource, it's recourse.
Debt is repaid mainly from project cash flows.
Okay, hold on. So, it's a non-recourse lending by the by the companies which are giving loan to the company. So, it's a non-recourse or limited recourse. That means the lenders, the banks who are given money, they can only get all their money back from the SPV. They can't go to the promoters or other assets of the company or other assets of the businesses and take money if the company is not able to repay the money back. The money will be repaid back from the cash flows generated by the project. आपने project लगाया, it is going to start producing money. Okay, cash flows. Those cash flows are going to only bear the loan repayment. Okay, fine. So that's why there's a separate legal entity. The liability of the company is limited. The sponsors, whatever money they have put, okay, and I'll answer your question. Okay, so there is no recourse to any other assets of the company. Just read the last line. You will understand.
Non-recourse lenders can be repaid only from the project's cash flow and assets, not from the sponsor's other assets.
Okay, so this protects the sponsors. Other businesses. You have opened a new business. It's a special purpose vehicle, a new company. Okay, working under the Indian Companies Act. So that means if anything happens to the company, then that company will be only responsible. The worst the sponsors or the promoters can lose is the equity which they are given to the SPV. Right? The SPV will get money from two sources. One from the lenders in form of debt, another from equity from the sponsors. So worst, there is a limited liability. The sponsors can lose only the equity at the most, nothing more. If the sponsors have some other assets in some other businesses which are run as other companies, their assets will not be touched. The lenders will be only getting their dues and repaid from the project's revenues. Okay, is that okay? Yeah, you also wanted to ask question. That is a very good question. Okay, we are going to answer that only. That's a very good question. Okay. So, I guess risk allocation. Just read this. Okay. Now, when you do business, and business is risky, isn't it? So, how do these companies manage their risk? The risk is distributed through contracts. Okay. So, company enters into so many contracts. First, an EPC contract. with say a company like Larsen. Now, company is going to set up plant for them. Okay, they say this is the plant, this is the cost, and the plant has to be given in the next 2 years. Okay, and it should have so much of specification, quality, and everything of the listing project. So everything there will be an agreement between the sponsors and the EPC company. What they'll do, they will do all the engineering, they will do procurement, they will do the construction, and build the plant in a specified period of time. They will make the asset, give it to the SPV. Okay. Now, it should meet all the criteria. Okay. So all the risk is taken by the EPC contract. If the EPC contract is not able to fulfill the time or the quality, if there is any loss, it has to be paid by the EPC company. EPC company is going to take the construction, procurement, and engineering risk. So the first risk is passed on to EPC company. Then the second contract will be with the O&M contractor, the company which is going to maintain the project, operation and maintenance. Suppose the life of the project is 30 years, so somebody is going to take the job that I'm going to maintain this company for next 40 years, and we are going to decide about what are the performance indicators or the measures. Okay, so all the machines will be maintained. There will be no downtime will be within the projected parameters. So company is going to run for 40 years and produce output. Okay, as desired, and through a contract, how much they are going to produce. The O&M contractor is going to take a responsibility of maintaining, running, and producing the goods as per the project parameters. So some risk is passed on to O&M. If the company is not able to run and if it's down or there is a breakdown, any losses will be borne by O&M contract. So the sponsors have only one risk, the money is there for. Two risks are passed on to the EPC contractor and O&M contractor. The third is offtake agreement. Company is going to enter 40 years, 30 years long-term contract with its customers at a certain rate. They are going to buy the output of this project for next 30, 40 years at a certain rate. So there is no demand risk. There's sometimes you are producing and there are no customers. But they are tie-ups done with the offtake. Like with the power plant which we are going to discuss in maybe next class, which was set up in Reva, a 750 megawatt power plant. Okay, where all the power which was being produced was sold to Delhi Metro. Like 30-40% of power was taken by Delhi Metro. Delhi Metro is a AAA rate company, okay, and which has taken the power at a certain rate from the power plant. It keeps increasing a little bit, so all that has been an agreement. So they are taken for 40 years. They are assured that they are going to get their money from Delhi Metro. Then the rest of the 60 to 70% of power was given to DISCOMs. There's a company in Madhya Pradesh, which is the overall body of all the DISCOMs. They take the power and give to the distribution companies. And those companies, they supply the power to all the household, factories and everything. And they have made a power purchase agreement with them for 40 years. So आपके output भी गिर, प्राइस भी पता चल गया, आपका प्रोजेक्ट का कैश फ्लोज आपको पता कितने आएंगे. So lenders, if I am a lender, I will be very happy to lend because they know there is no risk. Because the company is going to earn. If there is any loss, it will be taken care of one of the agreement. So risk is distributed through contracts. Stable cash flows, revenue often backed by long-term contracts. Is that okay? Fine. So I'm just going to share that. Some more things. Just read this. Read this in your mind, and then I'll move forward. Okay. So here the lenders are very happy to lend because they are not taking any risk. As they take risk in normal, case, you got the answer. बाकी केस में तो आपको कई सारी चीजें देखें, इसमें देखने की जरूरत नहीं है because they know that everything is there. All the risk has been managed by the company through various contractual agreements. That's why they are complex contractual agreements. Okay. Now the construction risk. Read this in your mind. Is that okay? Is it clear? Requires any explanation? Krish के साथ कौन है? There. What's your name? Acha, you're also reading. Good. So is it clear? Everybody, please focus on this slide. If there is any question, please ask me. Next, operating risk. Read this. So today I'm doing a lot of theory, but next time will be all practicals. We'll be entering into practicals. So there will be a lot of questions, in project finance. Okay. So all the paper will be all practical. There will be theory and practical. You can choose 100% of theory or you can choose 100% of practical. All depends upon your own understanding. Okay. Choice will be given. Is it okay? So here, stable operations, predictable cash flows, lenders comfort. So lenders are very happy. So they would like to, participate in these kinds of projects and give loans. Okay. Now revenue, just read this. Operation and maintenance. Okay. ये लिखा नहीं था मैंने कहीं. Operating O&M contractor. Okay. Please do ask questions. Suppose if I have missed out something, then I would be thinking that it's so easy because I've read it so many times. Okay. Is this okay? So revenue becomes contracted and not market driven. Is that okay? There, Sania. No issues. दोपहर का टाइम है खाना खाने के बाद थोड़ा सा देखो okay. So in project finance, risks are not avoided, they are contractually reassigned. So that means the subject is so boring, yeah? Okay, so next one, it will be a lot of practical listing, so you will enjoy it. Is that okay? Then financial risk. So read this. Just read this. So I'm going to explain here something, okay? So risk allocated to sponsor limited, they have limited liability to the extent of equity they have given. Maximum they can lose is the equity only. जितना पैसा लगाया है वही तो lose कर सकते हैं ना SPVs. Not beyond that. Okay. Lenders, of course, that is a major money which they have put. So if they lose, they will be not happy. Lenders, it's structured. Like what? Debt sculpting. I'll explain that. Designing the loan principal repayment schedule, so that the debt repayments closely match the projected cash flow, ensuring stable DSR over time. DSCR. DSR stands for debt service coverage ratio. Okay, fine. So that means how much cash the company is going to generate and what is the principal and interest. If you divide, you will get the DSCR ratio. Okay, fine. If your cash flow is more and the payments towards interest and principal less, so we'll get a figure higher than that. Normally, for all the power plants, the ratio which is accepted is 1.3. If the DSCR ratio is 1.3, then the lenders are very happy to lend such kind of a project. It's a power project. It is dependent upon industry to industry. Okay, fine. Is this clear? Now, debt sculpting and debt sizing. These are two very important, which I would have covered much later. But since you have to understand what is written here, I am just taking you to that sheet. Okay, I'll be covering. I'm just, I have not shared that file with you. See, this is a model which we have already created. Okay, you have to plug in the numbers and you will get the desired output. It's a financial model. Okay, to find out, the banks use it, how the loan is going to be amortized, how they are going to collect the principal and interest from their borrower, and what is the amount of loan they can give, the maximum loan they can give. Okay, so this Excel sheet is designed to calculate what is the maximum size of loan it can give to the borrower. Okay, based on his cash flows. So first document is, now all the blue ones you need to fill. The yellow one will get automatically populated. So first, you must know what is the loan period. So loan period is 12 years. This you need to fill up yourself. Okay, this is a column where you have to put the number yourself. Second, what is the interest rate? What the lender is going to charge? It is 9% in this case. Then target DSCR 1.3. So debt coverage ratio is 1.3. This is a target. Okay. Now based on this target and the discount rate, which is 9%, the interest rate itself, the cost of capital. Okay. You get the loan amount as 197 crores. So this amount will come automatically. So bank says if this is the case, we can give you 197 crore rupees. Okay. Fine. And how it has been calculated? The starting point is like this. First, you have to know what is my cash flow from operations. So 12 years is the loan period. For each year, I am going to calculate how much the cash the project is going to generate. So it is 30 crores, 32 crores, 34 like this, and then 40 crores like this. Okay, fine. This is the cash flow which the company is going to generate year over year for 12 years. Of course, the life of the company is much more, but we have restricted to 12 years because they're taking 12-year loan. Okay. Then we come to debt sculpting. Okay. How it is done? In the year one, the company gives a loan of 197. This figure is coming from the first sheet, which gets automatically populated. The moment you plug in all the numbers, this figure will come. Then interest you need to calculate, which is 197 crore into 9%. So it comes to 17.75, which is basically the B3 into B4. B4 is the interest rate, okay? And B3 is this, 197. Into, what is that? B4. B4, if you look at here, B4 is interest rate. Is that okay? Interest rate वहां से पकड़ लिया और ये जो लोन था ये यहां से आ गया पहली शीट से जो ऑटो कैलकुलेटेड है. I'll show you how it has been calculated later on. तो यहां आ गया और जो डेट सर्विस कितनी है 23.08 which is 1.3 based on 1.3 DSR. How it has been calculated? If your debt service is 23.08, which is if you look at the cash flow, it is 30. इसको डिवाइड करा 1.3 से, so we'll get the debt service ratio. Total debt, कितना debt, interest और principal दे सकती है कंपनी. If this is the thing, then we'll get a DSCR of 1.3. ठीक है? So we'll take the like this. If I take the this thing first year number here, and then if I divide this by the debt service, total debt service, so I'll get 1.3. Is that okay? Fine. Because I'm generating 30 crores of cash flow, so the total debt service can be, this is the money which I can pay to the banker, both the loan and the interest. Is that okay? So this figure is coming. So principal will be the balance number. क्योंकि अगर मैंने इतना इंटरेस्ट पे करा और इतना मैं सारा दे सकता हूं तो मेरा प्रिंसिपल इतना जाएगा. So this will be my closing debt. So at the end of the 12th year, I'll get a zero number. That means I paid all my debt. Okay. Maximum debt given by the model. Rest all thing, debt sculpting is called. So you have sculpted the debt. You have made the debt in such a way that your debt is repaid out of the cash flows generated by the company. Because the cash flows are uneven. So the formula or the model is making sure that you are repaying the debt. Whenever you are making more cash flow, you are paying more. Whenever you are paying less cash flow, you are paying less. So your debt schedule is arranged according to this model. Okay. Now we have then the LL. There is something called LLDSCR, which is the loan life debt service coverage ratio. The bank says we are not going to look at just 1 year debt service coverage ratio. We are going to look at the whole 12 years. What is a long-term long-term coverage ratio? Sorry, what was the LL? I said LL की पूर्ण definition क्या बोली थी मैंने? Loan life debt service ratio. Okay. Now how it is done? So this has been calculated here 1.3. This is the number which has been calculated by the Excel sheet. How? What is the CFAT? What is the cash? Cash flow available for debt service. CFAT. Cash flow available for debt service, which is picked from the first sheet. Okay. Then the debt service, which is 1.3 of this thing. 30 divided by 1.3. So then what I do is I have to calculate the present value of everything. So present value is calculated at a 9% cost of capital. So what I'm doing is I'm calculating the present value of CFAT and also the present value of debt service. And then I'm taking a division here. Okay, I just see the formulas here. So these two numbers will give me a targeted DSR, the debt service coverage ratio for the entire loan life. Using the present value of all the cash flows which I'm going to generate, what is the present value of all the money which I'm going to pay the banker, both interest and principal. So it is going to calculate the loan life debts coverage ratio. So this figure is being generated from there, and so here it is coming here. So what I have to do is I have to plug in this number here myself. It will get calculated there. Okay. Now, if I look at the last debt sizing, this is the last output number. What is the debt the company can get? The banker will look at the last line. How much? 197 crores. What is the loan life DSCR? 130. What is the closing balance I have debt? 0. Okay. So it will pick up the 0 from the debt sculpting number, and if the number is not coming 0, then I have to do my calculation to make. I will use the word I'll use the formula called goal seek. How? I'll just go to the data here and choose what if analysis. I go to goal seek. Okay. Then I say this value has to be 0. Okay. Fine. And then it will be calculated on the basis of the loan given here. This loan. Okay. So on this basis, the loan will be recalculated. So let's see if I can do. I don't know whether suppose I say it is 34. 30. Abhi change ho raha hai. Okay, so I have to just cancel this. Suppose I say 40 crores here, okay, and keep that number 40 everywhere. Fine. So then I'll go to debt sizing. I'll find the number is minus 65 here. Okay. So what I'll do, I'll go to goal seek. कहां पर था? What if, sorry. So I have to put value this as 0 to value. What is this number? B6. To value 0, sorry. By changing the cell, 0 ही आई है ना? कहीं वो तो नहीं आई 0. By changing so I have to go there and put this number and say okay. So now it has become 0. Let's see what is the loan I can get. Oh, sorry. और मैंने सारा उसको वापस चेंज कर दिया. Okay. So I go to the debt sizing again and go to what if this thing, go to goal seek and make it 0 here, and then I have to choose this number. Okay. Then I say okay. You know? I say okay. So now and then say okay again, and I'll be out of it. So the loan will be how much? 220 crores. Okay. And if I go to debt sculpting, it will go to 0. The loan is repaid on the basis of the cash flows the company is going to generate. Fine. So this is what the company, company has to decide. First, what is going to be the ratio? Okay. Fine. And how much maximum loan it can give. And debt sizing as well as the debt coverage ratio is the key for calculating this number. So let's go back to the slide again and we see if you can understand. Just hold on. हाँ बस इसको देख लो, इसको दोबारा देख लो, लास्ट है, खत्म हो गया. कितने बजे तक क्लास है? 5 मिनट रह गया. हाँ. Just read this and you can start taking attendance. So, just read this line now, it will be clear to you what is I have said. So banks take risk but protect themselves using DSCR, LLCR, reserves, covenants. We'll discuss that later. Okay. Yeah. We understand. We understand that is the discussion. That's great discussion.